Welcome to This Explainer. Today, we're going to unpack one of the absolute most dramatic reversals of fortune in modern history. We're going to look at exactly how the absolute euphoria, the sheer unbridled economic exuberance of the 1920s, transformed practically overnight into the most devastating financial plunge in American history. It's a crazy story of unchecked optimism, hidden structural rots, and the sheer contagious power of human panic. Let's get right into it. Okay, to really wrap our heads around the shock of the crash, we first have to understand the mindset of the country right before it happened. Just listen to the soaring optimism of President Herbert Hoover during his inauguration on March 4th, 1929. He said, and I quote, "I have no fears for the future of our country. It is bright with hope." And people believed him. The Roaring Twenties had brought this unprecedented industrial expansion. Rural Americans were flocking to the cities, the standard of living was skyrocketing, and folks genuinely thought they had cured poverty for good. Yet, in this brutal twist of historical irony, the terrifying reality of Black Thursday was ominously just 6 months away. And if there's one single number that perfectly captures all that hope, it's 381. By early September 1929, the Dow Jones Industrial Average had hit an all-time high of just over 381. To put that into perspective, the market had been on a relentless 9-year run. It had literally increased its value tenfold since 1921. And it wasn't just the Wall Street titans getting rich either. This boom was fueled by everyday people. We're talking factory workers, restaurant owners, even shoeshine boys, throwing every penny of their life savings into the market because, well, it looked like an absolute sure thing. Now, you know how it is. When a trend just keeps going up and up, it kind of warps reality. It created this incredibly powerful illusion of easy cash for everyone, amateurs and experts alike. Take this famously, or rather completely infamously, timed quote from renowned economist Irving Fisher. Shortly before the crash, he actually proclaimed, "Stock prices have reached what looks like a permanently high plateau." Wow. But when the absolute top financial minds of the era are telling you the prosperity is literally never going to end, it's pretty easy to see why millions of regular Americans were desperate to get a piece of the action. So you might be wondering, how on earth were everyday working-class people affording all this stock? Well, the answer is a massive, fatal flaw in the system: buying on the margin. Basically, you didn't actually need much money upfront to get into the market. You'd just borrow money directly from your stockbroker to buy the stock, and then you'd use the stock itself as the collateral for the loan. Sounds like a brilliant little life hack when the market is only going up, right? But man, it was a ticking time bomb. Let's actually walk through the mechanics of how this worked step by step, just so we can see the trap being set. Step 1, you put down a fraction of the stock's actual value, sometimes as little as 10%. Step 2, your broker loans you the remaining 90%. Now, as long as the stock price climbs, everything is great. You sell, you pay off the loan, and you keep that huge profit. But what happens if the stock drops in value? Because the stock is your collateral, your original 10% down payment essentially shrinks or just vanishes completely. And that instantly triggers the final step, the dreaded margin call. The broker demands immediate repayment of the loan in cash. And if you can't pay it, poof, you instantly lose absolutely everything you have. But here's what's truly fascinating when you peek behind the curtain. Beneath all that roaring prosperity, hidden structural rot was spreading everywhere. It wasn't just the stock market running on fumes and debt. Consumers are racking up massive debt through easy installment loans for exciting new things like the Ford Model T. Meanwhile, out in the country, there was a completely hidden agricultural depression going on. Farmers had been pushed to produce more during World War I, so they borrowed heavily to buy tractors and mechanize. But that just led to massive overproduction, which flooded the market with cheap wheat and crops, making it completely impossible for those leveraged farmers to ever pay back their debts. So behind the scenes, the entire nation was just absolutely stuffed with bad loans. Right, so eventually those hidden cracks had to start showing up on Wall Street. By 1929, the Federal Reserve Bank of New York was getting really nervous about all this margin buying, so they actually raised lending rates to try and discourage borrowing. And this caused a huge domino effect. European central banks matched the hike, sending nations that were still trying to recover from World War I straight into a recession. Add to that a highly publicized warning in September from financial analyst Roger Babson, who flat out declared a crash is coming and it may be terrific. This spooked investors and caused the initial Babson break, a sharp market drop that really signaled the descent had officially begun. And all of that underlying tension, it finally snaps over 3 infamous, terrifying days in late October 1929. These are the days that quite literally changed the trajectory of the 20th century. Black Thursday, Black Monday, and Black Tuesday. Let's see how this all played out. It all begins on October 24th, Black Thursday, and the screaming literally starts right after the opening bell. Minutes into the trading day, the market had lost 11% of its value. It was just a complete feeding frenzy. Floor traders were shoving, screaming at each other. And because so many trades were happening so incredibly fast, the ticker tape, the vital machine that brokers all over the country relied on for real-time prices, it actually fell up to 4 hours behind. Imagine that. Imagine desperately trying to trade your life savings, completely blind, based on prices that were 4 hours old in a plummeting market. The panic was incredibly infectious. And as you can probably guess, in a complete vacuum of accurate information, hysteria takes over. Huge crowds started gathering outside on Wall Street. Rumors began flying everywhere that ruined stockbrokers were committing suicide, literally leaping from the windows of their high-rise buildings. Now, actually, scratch that, these specific reports were completely false. They were actually sparked by the tragic death of a German chemist who had accidentally fallen out of a hotel window. But in that atmosphere of absolute dread, the public took these rumors as gospel truth, and it just poured gasoline on the panic. While all this chaos reigned on the trading floor, behind closed doors, a rescue mission was being put together. Several heavy hitters of banking, we're talking the heads of Chase National Bank, Morgan Bank, and National City Bank of New York, they meet in a back room. They all remembered the panic of 1907, which was a massive crisis that was stopped only when J.P. Morgan himself rallied his banking buddies to inject huge sums of cash into the market. Hoping history would repeat itself, these titans pulled together a massive pot of money to try and halt the chaos. So they hand this massive war chest to Richard Whitney, the vice president of the exchange. In this highly theatrical, totally deliberate move to restore confidence, Whitney walks right onto the trading floor, draws everyone's attention, and loudly offers to purchase 25,000 shares of U.S. Steel at $205 a share. That was a price well above what the panicked market was currently trading at. He did the same thing for a bunch of other blue-chip stocks. And amazingly, the psychological trick actually worked, temporarily. The bleeding stopped, and the market closed down only about 2% for the day. But Wall Street's temporary bandage did absolutely nothing for Main Street. Over the weekend, reality hit hard. The margin calls went out. All over America, regular people, dinner cooks, busboys, farmers, picked up their phones or got telegrams from their brokers demanding immediate cash to cover their plummeting stocks. We're talking $500, $1,000. Those were massive, completely insurmountable sums for a working family in 1929, sums they simply couldn't raise, even if they managed to quickly fire sell their cars or their homes. It was just a totally helpless situation. So the weekend ends, and the financial hemorrhage is just undeniable. Thursday was contained to roughly a 2% loss thanks to the bankers stepping in, but Black Monday, a staggering 12.82% loss. Everyone who got a margin call over the weekend simply had to sell, no matter the price. And then came Black Tuesday, knocking off another 11.73%. Think about that. That is nearly a quarter of the market's total value completely vaporized in just 2 trading days. To really wrap your head around the absolute pandemonium of Black Tuesday, just consider the sheer trading volume. While Black Thursday set a terrifying record with nearly 13 million shares traded, Black Tuesday totally shattered that with an unprecedented 16.4 million shares. The floor of the exchange descended into physical fistfights. The absolute nightmare scenario had arrived. Everyone was desperately trying to sell, and literally no one was buying. The market was in total freefall. Now, there were a few brief, temporary rallies in the months that followed, sure. But the illusion of the permanently high plateau? Yeah, that was dead. The market entered this long, grinding descent that wouldn't hit rock bottom until July 1932. By the time the dust finally settled, the Dow had closed at just over 41. The crash had erased roughly 90% of the stock market's pre-crash value. Billions and billions of dollars of wealth simply ceased to exist. The fallout was so severe, so absolute, that it completely reshaped the relationship between the government and the financial system. The Senate launched the Pecora Commission to investigate the abuses that led to the crash. Congress passed the Glass-Steagall Act, which forced a strict separation between commercial banks, the ones that hold your everyday deposits, and investment banks that gamble on stocks. They also created the Securities and Exchange Commission, or SEC, to regulate the markets and put up guardrails like the uptick rule, all to prevent the kind of wild, speculative manipulation that fueled the collapse. Now, here's a crucial distinction we need to make, because history often blurs these events together. The 1929 crash and the Great Depression are obviously deeply linked, but they are not the exact same thing. The crash was the sudden, violent collapse of the stock market, like a financial heart attack. The Great Depression was the grinding, years-long chronic illness that followed, characterized by massive nationwide bank collapses and devastating mass unemployment.
Actually, historians and economists are still arguing about this to this day. They vigorously debate the exact relationship between the two. Did the trauma of the stock market crash directly spark the Great Depression by destroying consumer confidence and freezing corporate spending? Or did the crash merely coincide with the inevitable bursting of a much larger global economic bubble fueled by easy credit and bad debt? We might never fully agree on the exact math, but everyone agrees the crash was the terrifying, undeniable signal that the party of the Roaring Twenties was officially over. Which brings us to a pretty massive question as we look at our own modern markets. Today, we have the SEC, we have circuit breakers, we have these massive regulatory frameworks born directly from the ashes of 1929. But we also just saw how the crash was ultimately fueled by the illusion of a sure thing, the euphoria of easy money, and the sheer contagious terror of the crowd. So, when you really think about it, as long as human nature, with all its greed and infectious fear, is steering the ship, are we ever truly safe from the contagious panic of 1929? Something to think about. Thanks for joining me on this explainer. I'll see you next time.